Welcome back, students who are taking financial accounting, and in this series of videos we are working on the assigned homework problems from the digital study guide for chapter 12, the group B exercises. Note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you don't understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. And in these exercises and problems for this chapter, this is especially true. If you don't understand the underlying concepts, because you can just look at a formula, but if you don't understand the underlying concepts to the formula, you need to go back and watch the theory videos, because watching me work out the problems will not help you if you don't understand the different parts that go that are pieced together in order to be able to work through ratios and things like that. So with that said, let me get my pen. All right, here, exercise 12-28, financial statement analysis. Consider the following: comparative income statement, then additional balance sheet data for iconic fashions. Let me just, okay, so this is the income statement, and this here is the additional, this is the income statement, and this is the additional data for the balance sheet. Right, for 2013 and 2014, compute the 5 ratios that measure how the business is investing its money and whether it is using its assets effectively. Round each ratio to 2 decimal places. Assume all sales are on credit. Did the company's performance improve or deteriorate during 2014? And so the first thing here is it says compute the 5 ratios. The 5 ratios that measure how the business is investing its money, right? Those are the, one of the key questions, the 5 key questions that were discussed in the chapter. Go back and watch the theory videos to see what those 5 questions are. This one here is how, in order to answer this problem, we're looking at how is the business investing its money and using its assets efficiently. So the 5 ratios are the accounts receivable turnover ratio, inventory turnover ratio, fixed asset turnover ratio, total asset turnover ratio, and the return on assets. You can find those in the exhibit in your textbook, or like I said, it was presented in the theory videos. So let's begin with the accounts receivable turnover ratio. Okay, so the accounts receivable turnover ratio is equal to the net credit sales over the average net accounts receivable. Okay, so let me see, how am I going to do this? So I need for 2013, 2014. Okay, all right, let me back up here. So I'm going to make this 2014 and make this 2013. And so this is going to be my accounts receivable turnover, inventory turnover, fixed asset turnover, total asset turnover, and return on assets. Right. So for the accounts receivable turnover, we're looking at our net credit sales, and that's over our average net accounts receivable. So what's our net credit sales? Okay, for I'm going to do 2014 and then 2013. So remember, all sales are on credit. So we're talking about 215,000, and this is going to be over our average net accounts receivable. So when we come down to our accounts receivable, our beginning balance is 22,000 plus 20,000 for our ending balance, and that's all divided by 2 because it's an average. Right, so this ends up being 42,000 divided by 2, or 21,000. So we're looking at 215,000 divided by 21,000, or 10.24. Right, so 10.24. Right, pause the video if you have to. I'm erasing this. Right, for 2013, we start out with 200,000 as our net credit sales, and notice that I'm, once you know how to do this, this is just repetitive work, right? So I'm talking 19,000 plus 22,000, and that's all divided by 2, and that's equal to what? 41,000 divided by 2, or 20,500. So I have 200,000 divided by 20,500, and that gives me 9.76. 9.76. Okay, pause the video. I'm erasing this. All right, so our next one is our inventory turnover, and inventory turnover. Oops. Inventory turnover is equal to the cost of goods sold over average inventory. So for 2014, what's my cost of goods sold? 118,000, and that's over my average inventory. My inventory is 6,000 plus 7,000, all divided by 2, which is 13,000 divided by 2, which is 6,500. So I have 118,000 divided by 6,500, and that ends up giving me 18.15. So pause the video here. All right, I'm erasing. Okay, see, so really what we're doing here is just basically, we're constantly, it's just math crunching, okay? It's just number crunching, but you do have to be able to pick the right information in order to solve the problem correctly, right? So 14,000 divided by 2 is 7,000. So I have 110,000 divided by 7,000, and that's going to give me 15.71. So my inventory turnover for 2013 is 15.71. Okay, pause the video. So yeah, you have to understand the underlying concepts to the formula itself in order to know where to get the numbers from. That's the understanding part. The application part is just doing basic math. All right. All right. So fixed asset turnover is equal to sales over fixed assets, average fixed assets. So my sales are 215,000, and that's over my average fixed asset. So fixed assets here are 148,000 plus 152,000, and that's over 2 because it's an average. So what that's 300,000 divided by 2, or 150,000. So I have 215,000 divided by 150,000, and that gives me 1.43. Okay, pause the video. All right, I'm erasing here. All right, so for 2013, I'm talking about 200,000, and that's over 146,000 plus 148,000. That's divided by 2. So that's what, 294,000 divided by 2, or 147,000. So 200,000 divided by 147,000 is equal to like 1.36. So 1.36. Right, pause the video. Okay. Then we have the total asset turnover. Total asset turnover is equal to sales over my average total assets. So my sales are 215 over my average total assets. So I have 180,000 plus 183,000 over 2, which is equal to 363,000 divided by 2, which is equal to 181,500. So 215,000 divided by 181,500 is equal to 1.18. Okay, pause the video. I'm erasing this. Now granted, yeah, this here's a lot of number crunching. You're doing it by hand. It takes a long time. And yes, there are computer programs, that can crunch these numbers. All you need to do is just input the data and it'll do all the math for you. And that's the benefit of having a computer. But you still have to know what numbers to put into the software in order to get the correct answers. And that again is where the understanding of the underlying concepts comes in. Okay. If you're not picking the right numbers, it doesn't matter what the computer does. It's not a magic box. It does not know what to do. So wrong data in gives you wrong data out. So that's 177.5. So 200,000 divided by 177,500 is equal to 1.13. All right, pause the video. I'm erasing this. Okay, and lastly, my return on assets here. Return on assets is equal to net income over our average total assets. So our net income is 33,500, and that's over the 180,000 plus 183,000 divided by 2, which is equal to 363,000 divided by 2, which is equal to 181,500. So 33,500 divided by 181,500 gives us 18.46%. Okay, pause the video. And lastly, we have 32,000, and that's over 175 plus 180 divided by 2, which is equal to 355 over 2, which is 177.5. So 32,000 divided by 177.5 is 18.03%. 18.03%. Okay, so Um, you know, now, what are we looking at here? Okay, so in the scheme of things, what you're basically doing is you're taking and you've created an income statement and you've created a balance sheet, right? Actually, let me do it like this, in sort of like a step process. You've created your financial statements, your income statement, your balance sheet. Then number two, you can create a comparative income statement and balance sheet using either the vertical or the horizontal analysis. Then number three is your key questions. Okay, what key questions are you going to be trying to solve for? And then doing that, you're looking at the various ratios that pertain to that key question. So you have to generate, all of these here numbers, right? Based upon the different ratios. So now what you're doing is number 5 is you're actually saying, okay, here's my data, right? And what does this data tell me, right? So in answering this question, it says, did the company's performance improve or deteriorate during 2014? And when, it's one thing to understand what numbers to put into the formulas, okay, in order to do the ratios, but it is a whole other thing in order to understand what the ratios are telling you, right? And the only way that you're going to learn what the ratios are telling you is by taking the different ratios and altering the numbers to see what the effects are. Like, for example, we're looking at return on assets here, okay? And so this was for 2013. So we have our net income here, and of course this is our average total assets. Okay, well, what I'm getting at here is you come up with this 18.03%. Well, what does that mean? All right, well, let's change the numbers a little bit. Instead of making this 32,000, make it 50,000 and see what the effect is, whether that goes up or down. Okay, change your beginning, change your ending, right? Instead of making this 50,000, make it 15,000 and see what happens. Okay, only by replacing the numbers, and I like, if you notice what I'm doing is I'm bracketing things here. I'm taking 32,000 and I'm sitting there and saying, okay, at the 32,000, I end up with 18.03, but then I bracket it by taking a higher number, and a higher number, 50,000, and a lower number, 15,000, and I see the net effects. And that's the only way you're going to internalize what that ratio is going to be telling you, okay? Until you do enough of that in order to get a good feel for increases or decreases, and you have to change all the variables. You have to change the beginning number. You have to change the ending number. It all depends upon the ratio. You have, every different variable, change it and see what the net effect is. But bracket it by taking a number that's higher and taking a number that's lower and seeing what the net effect is on that particular ratio. So when you see that and you begin to understand that, okay, I'm erasing all of this, then what ends up happening is you have a better understanding of what these ratios are telling you. Now, here it's just asking you for a simple question, okay? Whether it's improving or deteriorating. And in this case here, we're improving because all of our numbers from 2013 to 2014 are increasing, all right? And based upon these turnovers, and we're turning things over a lot faster. That's the idea behind turnover is how quickly can you flip it, all right? So I'm my accounts receivable turnover, okay? Where's my pen here? There it is. My accounts receivable turnover means I'm getting paid on my accounts receivable at a much faster rate. That's why it went up, all right? I'm not keeping my accounts receivable on my books as long. My inventory turnover, okay? I'm selling more of my inventory, all right? Whereas, and this is what I mean by this. Let's say I had 2 items in inventory, all right? And if I sold both items, that's turning over the inventory 1 time during the course of, say, a year, right? But if I sold those 2 items and I put 2 more items in, and I sold those, my inventory turnover would have doubled, right? It would have went up, which is what it's doing here, right? It's going up from 15 to 18 times, which means I'm selling a hell of a lot more, during the course of the year. I'm selling actually twice as much. Same with fixed asset turnover and total asset turnover, right? And then, of course, I have my return on assets. What am I earning as compared to my assets that I'm keeping in stock. So all of these numbers have increased, so the company is improving. Now, yeah, this is very simplistic in that they're all pluses, okay, and they've all increased, all right, but it doesn't necessarily. Not all situations are going to be this easy, okay. By looking at all of the different numbers, okay, it's going to take some thought as to what it is you're thinking about the particular company, all right, in order to be able to answer the question, how is the business investing its money and whether it is using the money efficiently. It may not be as simple as this where everything goes up. Some are going to go up, some are going to go down, and you're going to have to think about the relationships between the different ones, okay, in order to be able to more fully answer that particular key question. It's not, this is simplistic, okay. I'm just warning you right now, it's simplistic. It generally takes a lot more thought when you have numbers going up and you have numbers going down, and that's where understanding understanding what the ratios mean helps to determine whether you're improving or deteriorating, whether you're increasing or decreasing, right? So I hope that helps. I can't go about creating a situation that's really convoluted, all right? Hopefully, I just want you to be prepared that when you come across the situation, you have to really think about each and every one and what the ratios are telling you about that particular company in order to draw the correct conclusion, right? So with that said, I'm done with this video and I'm done with this exercise, and I'll see you in the next one. If you have any additional questions, feel free to contact an instructor.